Will company be able to survive? Will company be able to pay its current liabilities, or will it face liquidity crunch? Answer to all these questions you can get in the liquidity ratios, and that's what we're going to discuss in this particular video. Hey, this is Sri Amit Popat welcoming you all into this investing mastery series, and it's been going amazing. It's been growing brilliant. We have covered almost 17 parts, 17 videos, great in-depth knowledge of, I know not a single video is less than 10 minutes, right? So amazing content has come to your way. If you not watch all the previous parts, do watch it and then jump into this video. So let me start with the liquidity ratios. Liquidity ratios typically try to show what is the liquidity position of the company. Will the company be able to pay its current liabilities? How much safe company is in case of some urgency? If uh, you know creditors come and ask for the money urgently, will the company be able to pay or not? So these are all the things that we're going to discuss. So let's dive into it. So when we talk about liquidity ratios, the first thing that you need to understand is, like yesterday we discussed about profitability ratios, and you know that profitability ratios is something that directly hits a shareholder. See, why do I share shareholders? Because now we are very much focused, like we are looking at into this investing master series from perspective of an investor, that we want to invest into a company stocks, and that's why we are learning all this. That's why you are watching this video, right? So when you want to buy a company shares, definitely profitability ratios are something that hits you directly. If company's got a good GP, if company's got a good operating profit, if company's got a good return on equity, definitely that money will come into your pocket or the share price will go up and all that. But liquidity ratios is not that kind, because it doesn't show profitability. It only shows company's ability, that will it be able to pay its current liabilities, will it be able to pay its creditors, how things will go. Okay, this is something that is going to be reflected by current liabilities. So it doesn't directly hit, but it is very very important. Very very important, guys. I'm not saying very important, I'm saying it is very very important for a shareholder, because whether a company will be able to run in a long term, forget about long term, in short term or not, is something that is decided by the liquidity ratios. I'll give you an example. Like for example, if company is not able to pay its creditors for raw materials, earlier it has purchased some raw materials, it has not been able to pay the goods, it has got some liquidity crunch, it is not having money to pay off its dues. Now imagine for a second, what if that company stops supplying raw material to you? Imagine for a second now. What if the company stops supplying raw material to you? Your whole production will stop, your whole sales will stop, your company can stop. And now, don't you agree with me that it will affect you as a shareholder? If you agree with me, just type in yes in the chat box that Amit, it is very logical. These ratios are very critical for me, because a company will be able to run its operations only and only if it is able to pay its current liabilities. If it is not able to pay its current liabilities, sooner than later, mark my words, sooner than later, company's operations are going to get shut down. That is for sure. And look at it another way around as well. This is something very critical, and you will enjoy this. If company doesn't have money to pay off its dues for raw material, for creditors, can you expect that you will get dividend from that company ever in the life? Answer is but naturally no. Can you expect that if a company which is not able to pay its current liabilities, it is in super liquidity crunch, do you ever expect in life that the share price of that company will go up? Never. So as an investor, it hits you. You need to understand that, right? Chalo. So I hope you got my point. So there are three ratios typically we're going to calculate. Number one is a current ratio. Second ratio we'll be calculating is a liquid ratio, and third ratio we'll calculate is a cash ratio. With each progression, we will be using more stringent parameters to analyze company's liquidity. Like, as far as current ratio is concerned, the formula is current asset divided by current liabilities. Uh, 2 videos back, you can go. We have prepared one P&L and one balance sheet. And in the last video as well, I told you that we're going to continue that example with us till the time we complete this ratio part. Okay. Again, few more videos are going to come, minimum couple of them. Okay. So throughout the ratio, that data will remain with us. So if you look at that data, I had a current assets of 1.75 lakhs and 10,000 is my current liabilities. So I get the current ratio to be 17.5. And let me be very, very honest. This is a very, very, very high unnatural current ratio. And why? What is the reason for that? The reason for that is pretty obvious. There are two reasons typically. Number one, we purchase goods. It is a new company. We sold it. Majority of the sales happened in cash. That is reason number one. We had a huge cash of 1,20,000. You can check the balance sheet, go 2 videos back and you will find it out. And second reason is, as sales happened, to keep the matter simple, to explain you the accounting funda, I did not purchase again. But in practical life, it doesn't happen like that. Like if you purchased 80,000 worth of goods, you sold it for 150, you will keep buying, you'll keep buying, you'll keep buying, you'll keep buying. Okay. So that's how a business will work. But when I was explaining that accounting wala ratio video, I wanted to keep the thing simple, and that's why I kept it like this. So 17.5 is too high, but I'm just trying to show the calculation and all. Ideal current ratio is 2:1. And as written on the screen, that current ratio identifies whether company will be able to pay its current liabilities or not. So why 2:1? Because see, if you've got some debtors, if you've got some stocks, because current assets include what? Current assets include cash, stock, and debtors. So if you've got some stock, if you've got some debtors, if you've got some cash, but naturally, some stock will get obsolete. Some stock is going to get obsolete. If you got debtors, in practical terms, not each and every debtor pays you money. That's fact. You got to accept it, right? So that's why we said 2:1. We want to keep it as a double level, so that we are never in a crunch. We're never in a situation where we have to look here. Okay, how do I pay it? That's the reason for keeping it 2:1. The next ratio is quick ratio and liquid ratio. I'll tell you the logic over here first, and then I'll give you the formula. So as I told, the formula over here, the funda over here is, will you be able to pay your current liabilities or not? But when we come to the quick ratio, the formula, the fundamental behind, the rationale behind the quick ratio is, will you be able to pay all your current liabilities in urgency, or, and when I say urgency, I don't mean abhi ka abhi. In terms of business, urgency means 2, 3, 4 months. Okay, that is what something we call it as urgency in terms of business. Like a government regulation or something comes and tells you that, hey, you are not doing business ethically, pay off all your creditors within next 3 months. So of course, government agencies do tell like that. Okay, so will you be able to do that or not? So for that, what I'm going to do is, I subtract inventories from the current asset, because inventories will not allow you to pay your current liabilities in a short term. Because, see, understand this. If there is a stock, even if it's considering that it's a finished good stock, you will sell it. So from stock to sales, it will take some time. From sales, you will generate data. So all the people will not pay you money urgently unless you are a company like DMart. Like DMart is one such company, or if you go to these retail fashion brands like Zudio and Pantaloons and all, these are the companies where maximum sales happen in terms of cash. That's fact. DMart, okay, you tell me, have you ever purchased goods on credit from DMart? They don't give you, right? Unless you pay the money, you are not allowed to get out of the mall, DMart. So DMart, Pantaloons and all these companies which do business only on a cash, I'll say they are really blessed, they are really privileged. But otherwise, you got stock, you will convert that to daters, because when you sell it will get converted into daters, and from daters to recover the money, it will take minimum 6 to 8 months, considering the stock you have got is a finished good stock. God forbid if you got a raw material stock, then there is a whole production process also you need to complete. Raw material to WIP to finished goods, then you will sell it, and then daters will pay you money, so it's going to take a long time. And for that reason, we subtract inventory stock from the current assets. Okay, let me check. Okay, let me check that where do I exactly stand. So here, 175 is the current asset that I have got. Subtract 25,000 of stock, divide by current liabilities of 10. It is 15 times again. In this company it is very very high, because we have considered all the sales in terms of cash, and we have kept very less inventories. Otherwise, ideal current ratio is 1:1. If you have got 1:1, sorry, ideal quick ratio is 1:1. So if you have got 1:1, you are a good company, you are doing very good, you are doing pretty good. Just keep doing what you do, and you will keep flourishing. And the last ratio, see, quick ratio is stringent, more stringent than current ratio. Cash ratio is even stringent, even tighter than quick ratio. So when we are calculating quick ratio, we subtracted inventories. Like, okay, inventories will take time. Here in this ratio, we even don't want to consider daters, that even daters will take time. If there is urgency, God forbid, the only asset that will help you is what? Type in the chat box, type in the comment box. In case of super urgency, only asset that will help you is yes, you typed in the current comment box rightly, it is cash. But naturally it is cash. So here there is a typo. It's not current ratio, it's cash ratio. Cash in bank plus short-term marketable securities. Like if you got investment into shares, just sell it, and T+1 you will get the money in your bank account, or in your demat account. You got fixed deposits, liquidate it, and you will get your money. So short-term marketable securities, which are like you got commercial papers. So these are all the securities which can be easily liquidated into the market, and you can get the money. So you can consider that. Divided by current liabilities, in our example it is 1.2, divided by 10, 12 times. Very very good. And as I said, cash ratio is a very stringent ratio for measuring companies' liquidity. So guys, these ratios are very very important as far as analyzing the company's balance sheet is concerned. These ratios ideally typically belong from the balance sheet. Very important ratios. You need to understand this, you need to learn this, you need to observe it. And before you leave the video, again, as usual, I'm keeping you the same request. Give me two biggest learning. Give me two biggest learning that you get from this particular video. And I'll see you in the next video. If you're not subscribed to our channel, do subscribe it. Hit the like button to this video. See you in the next one. Bye-bye.